All right. Good morning, everybody, especially to the Bears. SPY is currently shitting the bed after the latest inflation report, with the producer price index coming in higher than expected across the board. Let me actually get out of some of these tabs so I don't overload the system. There we go. Okay. So let me pull up the economic calendar. Good morning, Gary. Welcome. We're going to read through this PPI report right quick before the market opens. So the core PPI month over month came in at positive 0.5. 0.3 is what was expected, and this was 0.3 last month. So core producer price index, or how much producers are paying more each month, is up 0.5% versus 0.3% last month, and it was expected to come in at positive 0.3. The PPI year over year, the core PPI that is, came in at 5.4 versus 4.9 expected. So that was 10% higher than what it was expected to be. So that was extremely hot. Last month was 5.8, so it is starting to cool off from the month prior. But this is the year over year reading. And then if we look at, let's see, the regular PPI instead of core, the year-over-year reading for January came in at 6.0 versus 5.4, another 10% higher than expected. This was 6.5 last month. And then finally, the PPI month over month was positive 0.7 versus 0.4 expected. And this is up from negative 0.2% the month prior. So we were starting to see deflation in PPI, and now that is resurging right back up. So not exactly great for the market. Markets are currently, again, shitting the bed. They were closing at 413, 414 almost yesterday. Now it's trading at 409. So not a beautiful start to the market, to say the least. Got some bearish trades that ought to be printing some decent money. 305, 306 QQQ put debit spread, as well as a Shopify put debit spread. Shopify reported their earnings yesterday after hours, and to my expectations, they missed on their revenue by a very large margin. I posted this in the free Discord somewhere, which I will link in the meantime. I also posted it on my Twitter, which would probably be easier to find. But let me link the free Discord. Oh, that bell always just rings my ears like crazy. Anyway, so there's a link to the free Discord. And then Shopify. Shop syncing. So this is probably the message where I sent it. And this is the post that I had made. Shopify down 6% after hours after posting an earnings quote-unquote beat of positive 7-cent earnings per share versus positive 1 cent expected. And their non-GAAP earnings per share, which doesn't include any share buybacks and employee stock compensation, came in at negative 49 cents. Revenue ended up missing very large at $1.73 billion in revenue versus $2 billion or $2.1 billion. Sorry, $2.21 billion expected. So huge miss on the revenue. And the earnings quality for the company came in absolute dog shit, which shouldn't really come as much of a surprise. But heading on over to the Robinhood, up a good few $100s at the moment. Hopefully the options start to load on me. Otherwise, I won't be able to close out of any of these spreads. These are going for 55 cents a piece. Up $60 for the position. And my assumption is that QQQ will be below 305, considering that we already sold off 1.4%. That does make this trade a little bit hard to hold on. But let's see. QQQ currently trading at that 304.43 mark. I wouldn't be surprised if we ended up bouncing on it Right now, we are very oversold on the RSI at 24. In the last couple of trading days, at least, we are below 50 on the RSI, and we ended up rallying right on the open. So I wouldn't be too shocked if that was the case yet again. Let's check in on the Shopify puts that I had opened. They're up by 200 for today. Total return up 136. I think this one's pretty much in the bag. Not so worried about this, more so worried about the QQQ trade. So we'll focus on that instead. And then the Dow put credit spread, that one's actually down with the Dow at 338, only down $30. I might consider cutting my losses for that. And then the McDonald's put credit spread still pretty solidly out of the money, so don't have to worry about that so much. But let's close out of the Dow trade first, cut our losses. So I opened 3 of these for 28 cents. Now they're going for 43 cents at the ask price. I'll try to get them out at 42. The bid ask is kind of wide on this. I might be able to get out at 41 actually. Maybe. If I'm lucky, if Robinhood will spare me some change. Oh, they did. Sweet. That's shocking. Alright, so just cut losses on the Dow put credit spread. Let me post that in the premium Discord. Closing options alerts. Premium. Just cut losses on the DIA 337, 338 put credit spread that expires tomorrow, which is 217, and I closed them at 117 for 3, which comes out to 39 each. So I actually got a little bit better than I expected. Let's see, DIA put credit. I originally opened those at 29 cents, so that one was a 30 loss. Originally opened 3 at 29. So 30 loss. Okay. All right, looks like we're headed a little bit back down for the Qs. But again, considering that we're oversold in the pre-market, the last couple of days at least, we were below 50 RSI and it ended up bouncing. So I'm going to try to close out as we come closer to that 304.43 mark. I think that will be my cue to take profits on this trade. Right now we're trading at 304.63, so about 20 cents away from it right now. The bid for these are 52. The ask is 58. I think I could probably get out between 55 and 60. Good morning, ice cold. All right. Yeah, it looks like I could get out at 55 if I want to. I could maybe hold on to them. Tesla and Apple shares were slashed by the Tennessee Treasury in Q4. So you're seeing some big institutions selling out of big tech, which is pretty concerning, especially for Qs, I would think. But we're at that 304.43 mark. Going right below it at the moment. Take profit. Don't wait. Let's see. I'll try it at 60. I'll try them at 60. I got 6 of them. There we go. CPI shrugged off, but PPI wasn't. Well, PPI came in higher than expected, whereas CPI came in at expectations. So I think that's why you got the decent sell-off. But just took profits on the QQQ put debit spread at 60 apiece. So nice little profit for me. Currently we're trading at 304, so I could have waited a little bit longer, but that's all right. Profits are profits are profits. Closing options alert. Premium. My computer is typing really slow, which is really annoying, but just took profits on the 305, 306 QQQ, put debit spread that expires today, 216 at 60 each. All right, and finally we got the McDonald's put credit spread. I'm gonna hold that one. And then the Shopify, that's the big hitter. A positive $160, 70%. So very good trade for the earnings report. Shopify. I do want to take profits on the ones that are expiring next week. I think that the ones that are expiring this week will be fine, but the ones that expire next week could be up in the air. So I would rather get out of those now than have to wait. And the bid ask on this is extremely wide at 60 and 85. So what I'll have to do, go over to Aries and get their bid ask spread, since Robinhood will always be a lot wider. But if we go to Shopify, I didn't want to favorite that, but okay. And if we look at next week's expiration, I chose the 50 and 49 strike prices for puts. 50, 49. So I chose really good strike prices here. And the order button. Didn't expect the strong reaction to PPI this morning. Yeah, I don't think many people did. I thought that there would be such a strong reaction to it either, just because like we already got the CPI report. We already know that inflation is high, but I guess this just kind of confirms that for the market somehow, as if the CPI didn't confirm that already. Weird market that we're in, but you need a triple confirmation before the markets start to sell off. All right, so the bid is 80. The ask is 85. We might be able to get out of these at 75. Actually, that shouldn't be right. We'll try, though. We'll try 75. See if we're filled at that price. I think there's just such low trading volume on it that nobody is going to buy or sell these to us. Unemployment claims came in lower than expected, too. Yeah. I didn't check on that one, but we will. All right. I'm going to try to close out at 70. Seems like the only thing that we can do. Again, I just want to get out of this just because it has so much time till expiration. And with as volatile as the market has been the last few days, not really worth holding for me. But good morning, Crypto Peter. Or should I say Peter? Good morning. All right, so made some decent profit on that. Closing options alert. Premium. Good morning, Julio. Just took profits on the Shop 49.50 put debit spread that expires next week, which is the 24th of February, at 70 each. Roku's still going strong. I was listening to Maverick of Wall Street talk about Roku's earnings, and supposedly the amount that they're paying on their debt is rising like hell, which, I mean, that's not really shocking considering how high interest rates are going up, but that I mean, considering that this is a pretty new company, Roku hasn't been around for a long time, considering that they don't make a lot of cash, that would be really concerning if they're having to service all of that debt. I would have to look at their debt balance and their cash flow statement to really dive deep into that. But Roku is currently up 11% today. After their earnings, they came in at negative 170 earnings per share versus negative 173. So a small beat, but a beat nonetheless on their earnings per share. You got some genius analysts calling for it to go to $75. Oppenheimer adjusted their price target to $85. Gotta love these analysts. I wonder if they're sell-side analysts or if they're buy-side analysts. Because that really makes a difference. Like if they're sell-side analysts and they're trying to sell you the stock. And they will try to pump it higher. But bought a put credit spread at 408 for SPY. Seems like an overreaction and that gap has to be filled. I don't know if it's an overreaction. I think that the markets have been disconnected from reality for a good while, considering that the 10-year treasury rate has been going up like hell. Now the 10-year treasury rate is at 3.85. Yesterday it topped out at 3.82. So this is just perpetually going higher. If we look at the 20-day chart, or the monthly chart, I guess this would be, it's up from 3.4 to almost 3.9. So that's really concerning. Whenever interest rates are going up, this usually puts pain on QQQ and tech and high growth names. But in the meantime, we've seen QQQ go from 273 to 305 in the past month, while interest rates have gone up at the same time, which usually doesn't happen. If we look at the yearly chart, you'll see that these have an inverse correlation with one another. Whenever the interest rates go up, QQQ will go down, and then the inverse, if interest rates are going down, QQQ will go up. And we can actually put these, I guess, side by side. Let me get rid of our studies. That way we can make this a nice, pretty picture for y'all. Let's see. Delete study set. No, I don't want to delete. I just want to remove all studies. And make this double wide. Look at TNX. Yeah, sure. That's what we'll do right now. So we're looking at the yearly chart for both of these, right? So whenever we saw the 10-year dipping right here, we saw, actually, let me make it vertical instead of horizontal. I feel like that would be a better visualization, right? So whenever the 10-year goes down, the markets typically go up. You saw in this same time frame. Whenever the 10-year went to a low of 1682, the NASDAQ rallied to $350. Rates started to rise. Looks like, I do want to make sure that these are the same time frame. It looks like they are. Rates started to rise a little bit in this period while the QQQ made its all-time highs, but rates didn't really start to go up a lot until right around this period right here, starting in March, right? So whenever the Fed started to raise interest rates, and then you saw a trough in the 10-year, you saw a peak in the Qs, and then you saw another peak in the Qs, a trough in the a peak in the 10-year, trough in the QQQ, and then these just kind of trade inverse with one another throughout these periods. But over the last month, that correlation has broken, and whenever the 10-year is going up, this means that it costs more money for companies to service their debts. So if you have a bunch of high-tech growth names that have a shit ton of debt, Roku, for example, then they're going to be paying more in order to service their debt, which means that their margins are going to come down because they're paying more in expenses just to pay off debt that they have. It's like, say you have $10,000 of credit card loans, and before you were paying an interest rate of 15%. You'd be paying $1,500 a year in interest, right? But now let's say that your interest rate has gone up to 25% because of the Fed's interest rate hikes. Now you're paying $2,500 a year in interest payments. So the same thing can be said about these companies, but they have much larger debt balances than the $10,000 of credit card that you have. They will have much lower, hopefully, much lower interest rates. Usually corporate bond rates, I actually don't know what a corporate bond rate would be. Probably between 5 and 10% right now is what I would imagine it to be. Good morning, Trills. Mike Trills. Good morning, German Shepherd. But yeah, that is the relationship between the bond rates and QQQ. Usually they have an inverse correlation with one another where one peaks, the other one troughs. And as of the last month, that inverse correlation has been broken. I wonder if I can change the study style. Yeah. Good morning, Kamala. Let me unstack these. So we're seeing a rise for QQQ back to 305.50. Glad that I got out of that put debit spread whenever I did. Good morning, Rich. And let me log out of my trades that I made. The Shopify 49.50 put debit spread. That one's basically at max value at the moment. I can try to close out at 90, which means that I lose out on $40 of extra profit, which, I mean, after making 150, I guess that does cut into my profits a bit. What is Shopify currently trading at? That's the question. Can I recap the market for today? Yeah, just give me 1 second. We're trading at 45 for Shopify. I think going back up to 49 would be a hard press, but let's see. All right, I'll try to close them at 92. I'll give up 8 times 4, $30 in profit. I feel like that's reasonable. Would I say locking in profits at 20 to 25% for spread options is generally good? I don't have a set percent chance, or sorry, a set percent profit or loss that I take personally. We'll talk about that. Mine is variable. And it depends on the trade, right? Like for this one, considering how far it is below the strike price that I chose, like it's almost guaranteed that this trade is going to work out for me. So I could have even held this into expiration and probably made max profit. But let me see. Let me post this right quick. Closing options alerts. Premium. Okay. Just took profits on the shop put debit spread that expires tomorrow, which is the 17th, at 92 each. And I originally picked those up for 53, 4 of them at 53. My system is just being real slow today. Extra slow. Shop put debit. 49.50 put debit spreads that expire 117. There we go. Opened 4 at 53. All right. So 92 minus 53 is 39 times 4, 156 profit for that one. All right. So general recap for the market. This morning we had the PPI, or the Producer Price Index, coming in, and that is on the economic calendar, which I will link here in the chat for you, Kamala. And basically every measure of PPI, or Producer Price Index, came in higher than expected. The month-over-month core PPI came in at 0.5 versus 0.3 expected, up from 0.3 last month. The core PPI year-over-year came in at positive 5.4 versus 4.9 expected, so 10% higher than expectations. And this is down from 5.8% last month. So it is slowing down, but it's not slowing down at a pace that the markets like. And then after that, you had the year-over-year reading for PPI, regular PPI, coming in at 6.0 versus 5.4, so another 10% higher than expected. This is down from 6.5, but still not at the pace that the markets want to see. And finally, the month-over-month PPI reading came in at 0.7 versus 0.4 expected, which is actually up from a negative 0.2% last month. So we started to see deflation in PPI month over month, and now we're seeing that inflation rising back up. But what Erwin asked, would you say locking in profits at 20 to 25% is generally good? I don't set a percent profit or percent loss that I want to get out of my trade at. It's going to be very trade dependent. And I'm monitoring my trades pretty much at all times. So I monitor my trades, here in the live chat for 2 hours in the morning, and then usually I'm checking back on them like once an hour throughout the day. So you do have to pay a bit of attention. If you don't have that much attention, you could set take profit or stop loss percentages. But the way that I trade, it's more based on how I think the trade is going to go. And it's more so based on like confidence, right? So if I have 90% confidence that my trade is going to work out and I have a debit spread, then I'm going to try to get out of a $1 wide debit spread at 90 cents. If that's a credit spread, then it would be the opposite. I would try to close it at 10 cents. That's generally the way that I go about closing my trades. So if I am less confident, if I think that there's, say, only a 30% chance that my trade is going to work out, then I'm going to try to close 30 cents for a debit spread, 70 cents for a credit spread. And, I've been doing this for a very long time. I've been trading spreads pretty much every single day for God knows how long. I would say that I started trading spread options 2.5 years ago, 2 years ago. I was trading regular options before that since March of 2020. So, getting used to trading spread options, you'll kind of get an idea of what is the likelihood of your trade working out or not, especially if you do it on a consistent basis. What price do I recommend AT&T at? That's a hard one. AT&T, I think that communication services, they're going to do fine. People aren't going to cancel their phone membership just because we're going into a recession. I think that people still need access to the internet and access to call their family and friends. So I think that AT&T is still a pretty good buy position. The dividend at 28 cents is okay. I mean, you're getting, 28 versus a share price of 19 right now, a 5% dividend, which is, around the same that you'll get from a treasury bond right now. But if you do get a rise in the share price because communication services aren't going away, then you would make a little bit more profit on it. But I'd say a good price for AT&T, I think that right now is a decent price for it. There's some supports right around 18.70 if you want to wait, just, a couple more cents, 20 cents. And then that gap right here, too, would be a decent buying opportunity at like 18.25. So I would say anywhere between 18.25 and maybe about 18.75 would be a good buying price. So if you take the average, like 18.50 would probably be good, in my opinion. Yeah, it makes sense. Love your content and how you explain my thought process. Thank you. I'm glad that I'm able to articulate it pretty well, even though sometimes I can't speak. Let's see. But yeah, I want to log in all the trades that I made today. I'm probably not going to trade for the rest of the day, considering how much profits I made. Feel kind of worn out after all that. All right, so the QQQ put debit spread. I had another put debit spread for QQQ too. I wonder how that's doing. I didn't check on that, but that's an important one too. That one's up by $80, trading for 38 cents. I ended up buying them at 35 cents a piece. And my assumption is that QQQ will go down below 303 by my expiration date, which is next Friday. I'd say there's a decent chance of that. These were trading at 40 cents each. I'll keep hold on them. See how that trade ends up playing out. But let me log all the trades that I made this morning, all the closings that I took. So the QQQ put debit spread that expires tomorrow. Where is it? Oh, that expires today, actually. This is closed by myself. I did not let it expire. And I ended up closing them at, what was it, 60 cents each? Yeah. 60 cents a pop for $90 profit. Where is my Shopify trade? Did I not log that? Let's see. When did I open my Shopify trade? 214. Nope. So I opened two of those actually. 214. Expiration date was Friday, and then another one that was for next week, but I closed both of those today. 214. Shop. Both of them were put debit spreads, which is a bearish strategy. Nope. Thoughts on in-the-money bull spreads? I think if you're buying in-the-money spreads, you'll overpay for them. So I personally wouldn't want them, but they could be a decent position, I guess. My typical trade is always going to be out of the money, just because you're going to get a better risk-reward ratio out of it. Like for these trades, I paid, what was it, 53 cents to make 45. But if you do it in the money, you're probably going to pay along the lines of like 60 to 70 per trade, which means that you can only make 30 to 40 for each spread that you open. So for me, the risk-reward ratio just isn't worth it. But the expirations I chose were two. That is not the right expiration. 217 and then 224. 224. Okay, well that didn't work out as it planned. Strike prices were both 49 and 50. And I opened 4 on each. The ones with the shorter expiration date at 53, close them at 92. The ones with the longer expiration date, I opened at, let's see, shop put debit spread. $52 each. And I closed those at 70. Let me drag this down. All right. And then the Dow trade, that one I ended up closing 2 today. Might have chickened out. Could have recovered some bit, but wasn't worth it to me considering the trade that I made for QQQ. Made up for it. These were both earnings trades, so they'll get labeled as orange. The Dow trade, that one was a hedge position, also based on fundamentals, based on the 10-year treasury rate rising. The Q trade, the put debit spreads were both fundamentals, again, based on the treasury yields rising. And then the Iron Condor, that one, not really sure my analysis for it, but that one I ended up making some profit yesterday. $90. Still holding the QQQ trade. But all of them are closed, but that one seems. Yeah. Sweet. Let me check in on the other positions that I might have. The NVIDIA trade I think I made last month. 303, 304, we already have that. The McDonald's put credit spread. That one, that one's actually not doing so hot today. That one's actually starting to pull back to 264. I still think that McDonald's is going to stay above 260. So I don't want to panic out of that position. Out of the money bull spread with 1 month out until expiration, you'll definitely pay a lot for that, I would think. No, with an out of the money, yeah, you'll pay less for it. So yeah, if you are bullish, say for SPY, and you think that it's going to go to something like, I don't know, $414 or something like that, you might be able to get that for pretty cheap. My assumption, markets are probably going to keep pulling back based on the 10-year treasury rate rising and rates across the board going up. The odds of a 50 basis point rate hike for March is going up, so I would be concerned with the rates going up and how that's going to impact the market, because so far the markets haven't been paying attention to the rates, but at some point the correlation has to break. But let's see, looking at the 1 month expiration, so if you go 30 days out, probably nobody's buying these because everybody's focused on the 0 data expirations these days. But if you assume that it's going to go, say, above 414, you would buy the 413, sell the 414. You're paying 54 for the trade, so you get about 1-to-1 risk-reward ratio, which that can be okay if you're okay with making that kind of profit over the course of a month. But if you're able to make that same profit over the course of a week, I would prefer to make it over the course of a week. And I also think that the risk is skewed to the upside. There's more potential of us selling off from here than going up. So I do have my biases. The VIX is up by 9% today. Jesus Christ, that's wild. What's interesting about the VIX, with the new 0 data expiration options, this could be artificially suppressed because the VIX is based on 30-day expiration options, right? 30-day until expiration options. So if everybody's focused on the 0 DTE and not buying 30 days out, then that means that the VIX is going to be suppressed because there's not a lot of volume, there's not a lot of interest in the 30 days. I forget when these were introduced. I think they were introduced sometime in November of last year, if I remember right. And ever since then, the VIX has been below 25.85 or 25.50. So I'm curious if that'll be like the new 30, considering the new 0 data expiration options. Not too sure about that. I think it's very interesting, though, that the 0 DTE could be possibly suppressing the VIX. I wonder if they'll restructure the VIX too. Sweet. So got all of my trades closed out that I need to close out. And if we look at today's profit, it should be a pretty big day. This might be my biggest day. Well, if I had the formula here, it would be. Do I trade Iron Condors? Yes. I opened a QQQ Iron Condor yesterday that I was able to make profits on. $288 in profit, so I ended up outweighing that $266 loss day on the 13th, so making our money back for the month. And hoping, praying that we can end every single day for the rest of the month in the green. That is the goal, at least. And yeah, I do day trade Iron Condors. Yesterday, I ended up opening a QQQ Iron Condor. If we go to my history, let's see. It's not showing the Iron Condor that I had opened, but I can show it here. QQQ Iron Condor, this is a neutral strategy, of course. My strike prices that I had chose for yesterday's expiration were 303 and 308, so I was assuming that QQQ would be jumpy in both directions, or I guess trade in a range between 303 and 308. I ended up opening just 3 of them. I wasn't super confident in the trade. I only risked around $200. I ended up opening them at 30 cents and then closing them at 18 cents. So I was able to make only $36 in profit out of that trade, but the time that I had closed it was actually pretty good. The timing for that trade was on point. Not that my trading timing is ever very good, but that one definitely was. So for QQQ yesterday, again, I assumed that it would be between 303 at the bottom, so above this 303.60 mark, and then 308. It did end up going above 308 later in the day, but I ended up closing out of it on this pullback right around here. So I think it was this candle at around 12:35 when it tried to hit that 306.18 mark, and then I exited out. And then for the rest of the day, it ended up rallying. So glad I got out of that. Glad I got out of that position when I did. But right now, QQQ is trading at 305.70, so rebound just like we saw the last couple of days. People are just buying the dip relentlessly. I want to check in on Tesla. I want to sell maybe some of my shares that I have there. Currently trading at $214. I think that's better to sell out of some than to keep on buying for the long term. Let's see. Those trades I own over in Fidelity. And it's not to say that I don't believe in Tesla for the long term. It's just that right now, on a short-term basis, it's very, very pricey, considering the rising rates and the macro right now. It doesn't seem like a great opportunity to keep on holding. I would rather be in cash, but that's just my skew. All right. And I might end up buying some more shares of other companies with the cash that I get out of this. Let's see how many shares I've got. I've got, well, where does it say my share position? 31 shares here. I've got another 5 shares on Robinhood. So 36 shares, so I'll sell 3 of them. Collect $600 in cash. Thermo Fisher has a lot of cash. Yeah, Thermo Fisher's stable as hell, which to be expected. It is a healthcare company. So healthcare generally does better in a recession because people are still going to go to the doctor even if we're in a recession. People still need to go to the doctor. But let me type in the sell alert. Just sold 3 shares Tesla. And yeah, if you look at Thermo Fisher, this stock has barely dropped from its highs. Currently trading at $561. And if you look at the yearly chart, this is only down from 618. So hardly a drop at all, just kind of trading flat throughout the year. I think that I ended up selling it at around 580. Not sure when, but I sold it at 580. Probably should have bought it when it was in the low 500s, but I didn't feel like adding to that position. A position that I have been adding to has been Fulgent Genetics, genetic testing company. A lot of cash on hand, so not too worried about them going bankrupt like a lot of the other genetic testing companies. But, their share price is down by 50% year over year just because they kind of get lumped in with the other genetic testing companies. And they're supposed to be reporting earnings pretty soon, too. Announcing earnings on Tuesday, February 28th, so 2 weeks from now. I would imagine that their earnings per share would come in pretty abysmal because a lot of their earnings has come from COVID testing over the last 2 years, and COVID is over now, right? As of May 15th or whatever, 2023. So lack of COVID testing means that they're probably not going to be as profitable as they were for the last couple of years. But they are making a decent margin off of their genetic testing business itself. They're continuing to expand the company over in China with a joint venture. And I think that this is the only genetic testing company besides Illumina that has positive free cash flow. So if you're looking for a positive free cash flow company that's in a high growth sector, I think that genetic testing will probably be pretty big in the next 10 years, maybe 15 years. I think that Fulgent would be the choice. But you also got PacBio, which is burning money like no other, which is up from 385 to 1086 right now. And then you have Invitae trading at the lows at 211 versus 167. You also have BNGO trading at 157. 116 was the low, and they ended up peaking at 435. Jesus Christ. That stock went parabolic, especially back in, 2021? Yeah, went all the way to 16. But that's kind of the case for all of these genetic testing companies. They all peaked in early 2021. Invitae at 61, PacBio at 53, and then even Fulgent Genetics at $190. So basically a bubble that we saw for genetic testing companies, and that bubble has certainly popped. Ten-year Treasury rate is still holding up, but it is pulling back a bit. 385 right now versus a 387 high. I want to see this go into 3.9. I think that's when the markets will start to really capitulate. I want to see if there's any. I think we had some Fed members speaking this morning that I wanted to get the commentary from. Let's see. Fed Loretta says that more upside inflation surprises could make the Fed policy more aggressive, so they could go back to the 50 basis point rate hikes. Interesting enough. Fed Loretta says that the Fed will be more forward on balance sheet reduction effort. They actually ended up adding to their balance sheet, I think, last week, so it was kind of odd. But they do seem to kind of add to their balance sheet like once a month or something. Like, If you go to the Fed balance sheet, and shorten this time frame really short, they ended up going from $8.4 trillion on their balance sheet, $8.43 trillion to $8.435 trillion. So a couple, wait, is this in trillions or that would be billions, right? So they added a couple $1 billion to their balance sheet over the course of a week from February 1st to the 8th. But overall, this has been declining, right, since April of last year from 8.965 trillion to currently 8.43. So Loretta is saying that they're going to sell off more of their bonds, which is going to place more pressure for the yields going higher, which is no bueno for tech stocks. And then if we look at the FOMC watch tool, this is where the rates are expected to be. This actually ended up jumping from 10% to 15, actually 18% now. So this climbed from 12% to 18% from yesterday. So the odds of a 50 basis point rate hike for the month of March is actually climbing a decent bit. And this is up from just 9% a week ago. So this is doubled. But it is still a very low base at 18%. You would need this to be above 50% in order to secure it and in order to get that 50 basis point rate hike. It would be really interesting if we saw like a 50-50 split between 25 and 50 basis point rate hike, and then what the Fed would do from there. If the Fed had to make their own decision on that, that would be chaotic. But Mester also said, let's see, we'll move forward with balance sheet reduction efforts. U.S. cannot default on its debt. Yeah, they'll just take out more debt to pay off their debt. Loretta says that does not expect the U.S. to fall into a recession. That's what every Fed member has said, but that is the necessary evil to get rid of inflation. Messer says that Fed has no intention of changing the 2% target, would oppose such a shift. Do I think DoorDash will beat their earnings? No, I don't. I think that DoorDash is probably going to miss on the earnings. I think that it's going to be very similar to... Actually, I say that, but I actually wrote my analysis earlier this week, so let me look at that. So if we go to Notion... And if we scroll down, DoorDash, this is my analysis. So after Lyft or Uber could go either way depending on cash flows. They were cash flow positive with $2.3 billion in cash as of the latest quarter. But a lot of this came from employee stock compensation, and considering that their stock is crashing. And they spent 16% of their cash balance on share buybacks. Do we think this is sustainable? In my opinion, probably not. And if or when they stop doing these share buybacks and employee stock compensation, then their earnings per share is going to plummet on a non-GAAP basis. But their earnings per share is expected to come in at 70 cents versus negative 70 cents versus negative 77 cents last quarter and negative 45 cents the quarter before. Their average earnings per share for the last 2 years has been 75 cents. And their revenue is expected to come in at $1.76 billion versus $1.7 billion last quarter, and then $1.3 billion a year ago. So I think that they're going to beat or meet on the revenue. Earnings per share is up in the air. And looking at the stock price for DoorDash, it's at $68. I think that there's a good chance that it could come below where it's supposed to be for the end of this week at 64. But, considering that it's already trading above that, it makes it a little bit harder to make this trade. I would say almost certainly that it would stay below 74. But we have seen, stocks like Airbnb rising, 15% after their earnings report, still rallying. another 5% today. So it's kind of hard to take the position against the DoorDash. You really don't know what to expect out of this. Let's see. But if we want to open a 74 call credit spread, I don't imagine that we're going to get paid a lot of money for that. Let's check, though. So if I assume that it's going to be below 74 as of next week, I'll set the expiration date for next week since tomorrow is the expiration date. That way I give myself a little bit extra time for the stock to go which way I choose. I'm only getting 11 cents to open that, so that's not worth the risk-reward ratio for me. If I think that it's going to come back within the range that it was expected to be for this week, down to 64 with a put debit spread, I'm going to end up paying, let's see. That did not work out. I'm going to end up paying, God dang it. 60 cents to open that option. That's ridiculous. Oh, it's because of the bid-ask spread being so wide. Okay. I guess I'll have to try to do it on Aries instead. So we'll go to Aries. That is not Aries. DoorDash. Do I think that the market will crash with the huge U.S. debt? I mean, if they were going to crash on the huge U.S. debt balance, then they would have crashed a long time ago. The possibility of the U.S. defaulting, on the other hand, if that does happen, that would be very tragic for the market, because that means that all the bonds that have been getting bought up, they're not going to get paid out. So that would be chaotic, to say the least. All right, the bid is 41, the ask is 37. It's an okay trade. Considering that you're expecting it to fall $4 from 68, 69 almost, you would need it to fall by 6%, which, I mean, that's definitely in the cards. If this is anything like, what was it? The last trade that I made for, let's see, Shopify. Shopify saw a good rally going into the earnings report the last couple of days, but then sold off right on it. So if it is like that, yeah, you could see a decent 10-15% sell-off, and you would be below those strike prices. But what are the odds of that happening? That's the big question to ask yourself. I could take on the trade. I'm just not too comfortable with it. If we're saying 66, I'd be more comfortable with that. But then you're going to pay more the higher your strike price is. So if we go and choose the 66 strike price for a put debit spread, get rid of this one and get rid of this one. Place the order. This one, actually, you're not paying any more in order to open that option. That's strange. You would expect to pay more for this option than the one previous, but maybe I set the wrong expiration date. All right. So we set next week's expiration, assuming under 66. You're paying 45 for that. That's actually a decent trade that I might be willing to take. That one, I would probably only open a few of them, like 3 or 4. I think that there's a decent opportunity in it, but I don't think that the opportunity is too secure. So I'm probably only going to spend like maybe $100 on this trade, or like 120. Like 3 of them at 45 would cost me $135. Yeah, that I'd be okay with. But again, not exactly the most secure trade in my opinion. And actually have to overpay in order to open it for 50 cents, I'm guessing. Yeah. All right. So I got 3 of them at 138. So I'll post that. New options alert. Whoops, can't type. Just opened a new dash, put debit spread, expiring next week, the 24th at 40. Let's see, 138 over 3, 46 each. Strike prices again, assuming that it will be below 66. But yeah, that's probably all the trades that I'm going to make for today. Not really seeing much other opportunity considering we already got the drop on the PPI report. I think we got some more Fed members speaking later today that I could trade on. Loretta and Mester already spoke, but I think we have another speaker today. If we go over to the calendar, today we have Fed Cook speaking at 4 p.m., so that's going to be after the market closes, but you have Fed Bullard, which is either the first or second most hawkish member, speaking at 1:30. So if you want to trade around Fed speakers, that would be probably one of the better ones to take on. And then Fed Cook speaking at 4 p.m. after hours. So you might get some more volatility in the afternoon, depending on what these Fed members are saying and how the bond markets and the Treasury yields react. Right now, 10 years at 3.84, so it is pulling back from its 387 high, but still significantly above where it ended yesterday at 3.82. All right. So that's all the trades for today. I will open the floor for questions for the next 30 minutes. So if you'll have any options questions, if you want me to analyze stocks, or if you want to talk about the U.S. debt at $31 trillion and the possibility of the U.S. defaulting, that is pretty chaotic. But, I mean, this always happens too at the same time. Like every single year, there's always the threat of the U.S. defaulting, and then magically, the politicians end up raising the debt limit and, going about their merry way, spending as much money as they want to. Thank you for the Shopify trade. It is really good. Thank you, Irfan. Glad that it made us money. For sure, for sure. That was a really big drop. That was almost like the Lyft trade that I took on. It's Lyft ended up dropping like 30%. Shopify ended up dropping 15% after their earnings. Could have probably made more money just buying a regular put option with this one again, but I mean, I'm fine with the profits that I had made on it. What do I think of a short-term call credit spread for Tesla? I think that Tesla has some ways to pull back, so I think that a call credit spread could be okay. The problem with Tesla, though, is it's just so disconnected from reality right now with the interest rates rising. You would think that this super high growth name, it's expected to grow at 50% a year. You would expect that this high growth name would be hurt by the increasing interest rates, but it's been very resilient, going from 124 to 215, basically doubling in price over the last month. So based on a trend analysis, I wouldn't take the trade. Based on a fundamental analysis with the rising treasury rates, I would take it. What strike price you would choose? That's kind of the $1,000,000 question, I guess. Right now it's up by 0.3% today. I would say it would be hard pressed to go, I don't know. It's at 215 right now. Another $15 would be 6-7%. Let's see. 215. What if it goes up another 10? I'd say between like 230 and 235 it would pull back, so that could be a decent call credit spread. Like set up a 230 sell and then a 235 buy. But that's based on fundamental analysis. If you're based on technical analysis, then you could end up getting ripped apart. Yeah, Tesla is definitely a monster of its own, especially with the leader, old Elon Musk, and his crazy ways. Could I look at CSX? Did my dash spread fill? I think so, yeah. I ended up filling at 46 each instead of 50, what I put in. CSX. Haven't heard of CSX, but I'll look into it. So CSX Corporation, currently trading at 31.50, basically in the middle of its range that it's been in over the last month. Executive officer to address Barclays Industrial Select Conference. Quarterly dividend raised 10% to 11 cents a share. That's not much for a $31 stock. That's only... Oh, that's a quarterly dividend, so you'd multiply that by 4, 44 cents a year for a $31 stock and get about a 1.4% dividend yield. That's very low. But let's see, the stock is trading at 31 versus a high, 52-week high of 38, 52-week low of 25.80. So it's basically right in the middle of its range for the past year. They are a profitable company, so that's good to see. 49-cent earnings per share. The one before that was 52 cents, 54 cents, 39 cents. So they seem to have a very stable earnings per share. That's a good sign for any company. And if you look at earnings growth for the past couple of years since COVID hit, 99 cent, 93 cent, 52 cent, 43 cent. So their earnings per share has actually come down a bit since COVID, interesting enough. But considering that it's stabilizing around 50 cents a share, I would say that's a decent position. And then you would want to look at their cash flow statement. Let's see, CSX Investor Relations. Try to keep this brief. Quarterly reports. financials, we want to look at the 10Q for the latest quarter. Cash flows. Free cash flow before dividend was 3.7. Not sure if this is in millions. Yeah, this is in millions. So it's $3.7 billion. So they are cash flow positive, which is good. It's what you want to see, especially right now, a company that is generating cash from the business itself. And if you look at the cash flow statement for the year ended 2022, they ended up making $5.6 billion in cash from the business. $1.5 billion came from depreciation and amortization. And their net earnings, so from the company, was $4.1 billion. So that's really good. You want to see a lot of it coming from net earnings. They ended up investing $2.1 billion in cash, and then they ended up using $3.8 billion in financing activities from repurchasing their shares. Not my favorite place to be putting in cash for any company. I would rather them pay it out as a dividend, but it is what it is. And then the amount of cash that they have at the end of the quarter was $1.9 billion. At the beginning of the year was 2.2 billion, 1.9 billion at the end of the year. That is kind of a low cash balance, but considering they're making, $4 billion a year, if they stopped spending their money on investing activities and financing activities, they would be just fine. $10 credit spreads for Tesla, expiring March 10th. Yeah, I'd say the longer your expiration date for Tesla and tech, probably the better. Just because at some point they're going to reach reality where the 10-year or where the rates are going up so high that tech and growth just can't go up anymore. Did I analyze the Shopify play the other day the same as other earnings? Yeah. So I always do it on my Notion page right here. Right here. So what I do is I look at their earnings per share, what's expected, the previous earnings, and then the historical or last 2 years, and then I try to make an analysis out of that. So they're probably going to meet or beat their earnings per share, but the problem with the stock is the price. So if you're looking at DoorDash, it was expected to be in a range between $50 at the bottom and $64 at the top for this week. So considering that it's trading outside of the range, if the earnings come in to expectations, and even if they beat slightly, they are still trading above where they should be for this week. So my assumption is that they'll probably come back within the range that they're supposed to be at 64, and I open that 67, 66 put debit spread. And that's expiring for next week. The caveat here, I didn't put a lot of money down on it just because we have seen stocks like, Airbnb rally a good 15%. So that's what kind of made me let off the gas on this trade a little bit. And Airbnb is up another 5% today, so up a total of 20% for the last 2 days. The earnings per share did come in positive at 48 cents versus 27 cents expected, so that's definitely a positive. But considering the 20% rally, I think that could be a bit much. Fed Loretta Mester saw a compelling economic case for 50 basis points, which could have brought the top of the target range to 5%. So she said that for the last meeting. So she said that there was a good case to raise 50 basis points at the last meeting, which could mean that, they backtrack on going from 25 and back to 50. But that's only based on one member, right? There's, I think, 13 voting members of the Fed, so they have to come to a consensus of raising back to 50 basis points in order to get that. So if you see other members kind of echoing that same sentiment that inflation is too high and we have to go back to the higher interest rates in order to cool off the economy, then you could get that 50 basis point rate hike. But based on one member saying it, it's not enough evidence. And you can look at the FOMC countdown tool. This did end up increasing the odds of a 50 basis point rate hike, but not significant enough to put it in the bag. Like there's only a 15% chance when you need this odds to be above 50 in order to get the 50 basis points. What are my levels for SPY today? Let's see, SPY. Currently trading at 411. I have that 411.02 mark that it ended up just crossing above. Got some supports at 409 below that, 408.03. So if we do end up pulling back and giving up all the gains that we made this morning, we'd be back to 408.03. You got a resistance at 412.40, 414.41. I would say we're hard pressed to go to 414.41. So a call credit spread for that price might actually be a decent idea. Trading about $3 away from it, so SPY is currently down 0.7%. We'll see how much we can get paid for it. So 414 call that expires today. You're only getting 10 cents in credit for it, so that's not even worth it. If you set your expiration date for tomorrow, you get paid 23 cents in credit, so that could actually be an okay idea. And that would be assuming that we couldn't recover from where we were before the PPI report this morning. Let's see. What do we have on the economic calendar for tomorrow? Let's check. Investing.com economic calendar. I already do have a downside trade for QQQ, so probably shouldn't take on another position for the downside since I'm already leveraged. But tomorrow we have import-export prices. We have Fed Bowman speaking, and that's about it. We don't have any news. The only thing that would drag us down possibly tomorrow would be the maximum pain point. So where the most open interest is on the option chain for the third week. So that would be Friday the 17th, and the price level is 405. So if the market makers want to inflict the most amount of damage, they're going to try to send SPY all the way down to $405 by the end of tomorrow in order to make all of the options that expire tomorrow worthless. But considering that we're trading at 411, that's $6 down from where we're trading right now, which will be a 1.5% drop between today and tomorrow. And considering that the VIX is only trading at 19.15, I'd say it would be pretty hard pressed to see that much of a drop. But I do think that we'll probably be bearish. I don't think that we'll make our way back up to that 414 mark. It is possible, just unlikely, in my opinion. Yeah, no problem, Shark. Did I answer the spreads question? Let's see. What determines opening a spread? Uh, I mean, it's really there's two things that make me choose spread options versus a regular call or put. Either the price is way too high. If you look at the price for SPY options, they're like hundreds of dollars that I'm not going to spend on a single trade. Let's see. So if I want, say, a 414 put that's expiring tomorrow, assuming that SPY will be below 414, I would end up paying $351. My break even for this would be 411.50 ish. So I need SPY to be below 411.50 in order to make a profit on this. Whereas if I opened a call credit spread at 414, assuming that it would be below that, I only had to pay 79, or sorry, that's not right. Call credit spread, assuming under 414. My max loss for this trade is $72, so I'm only risking $72 instead of risking $450. So this reduces your risk. You don't have to pay nearly as much money in order to open it. And the second reason why I would use a debit spread, a spread option versus a regular option is if implied volatility is very high. So, for example, DoorDash has their earnings today after hours. And if we go to, say, their yearly chart and look at implied volatility percentile, which is where implied volatility is right now versus where it's been, it's at 27%, which is relatively low compared to the last year. But the last year has been very volatile for DoorDash. But if you look at the last month, say, for implied volatility, it was down to basically zero, so the lowest that implied volatility had ever been, and now it's at 30. So if you're looking at a monthly basis, well, even now it's at 11%, interesting enough. So with this trade, since implied volatility is so low, it would be better to buy a put option rather than a put debit spread, depending on how much they're costing too. So if you go to DoorDash, go to their option chain, my assumption is that it will be below 66. So you want to look for a break even to $66, which would give you the, let's see, $70 put option that you're paying $365 for. So 70 minus $365 is a break even of $66.35. But you're also paying nearly $400 for that option. Sorry, that's a call option. The put option is $415, but you're paying $400 for this put option, whereas I only spent $150 for my put debit spread. So debit spreads really reduce, debit and credit spreads, I should say, really reduce the amount that you have to pay into your trade. Any inclination of the recent surge? Probably just a bounce on being oversold. That's what's happened over the last 2 days of trading. We got oversold, or we were below 50 RSI, and then rally ended up ensuing the couple hours after the open. Right here, we ended up rallying till about noon, and then the day before that, we ended up rallying till about 10:30 before dropping. So just kind of the market's buying up the dip at any chance that they can. Senate Republican leader McConnell says that he will take message to NATO on Friday that it must do more to follow the lead of the U.S., increase defense spending, and upgrade capabilities. Oh, that's a funny one. You think that NATO is going to spend more money on defense when the U.S. always foots the bill? Probably not. Why waste their own money when they can waste ours? Yeah, QQQ and SPY are both going pretty crazy. QQQ is back up to 307.50, so definitely glad that I closed out of that put debit spread. Definitely glad about that. I'm looking at risking 200 to open a call credit spread, assuming SPY will be below 414. I only get paid $81 for it, but hey, $81 is $81, right? Better than nothing. And that's for tomorrow's expiration. So if we do get that max pain down to 405, that would definitely be secured, but I didn't put up a lot of money on it. Betting against the trend right now, and the trend is really hard to bet against these days. New options alert. Just opened a new 414, 415 SPY call credit spread, expiring 217 at 27 each. Yeah. So if we get a day of chop like we saw, what was it, the CPI day and yesterday, this trade would be in the bag. I probably wouldn't expect us to go much above like 413 in my best guess if it is a choppy day. But if you do see the continued bullish price action that you're seeing right now, that could easily be blown out. Hate the PDT rule. Yeah, I think everybody does. My account's over 30, which is most of my money is in cash. Like I have $20,000 or $17,000 in buying power, just so I'm over the 25,000 in order to day trade as much as I'd like. So if you have cash, I would say put it in your broker account, and they're going to pay you a decent interest rate. Actually, no. The interest rates, if you're a day trader, is actually lower than what you'll get if you don't day trade. They're supposed to pay you out 4% if you don't day trade, but if you are a day trader, I think they only pay you out like 1 or 2%. So you end up not getting as much in interest payments, which is really annoying, but that's the life of a day trader. But yeah, we're pulling back to that 411.02 mark, so call credit spreads ought to be doing somewhat okay. Maybe back to break even, since I'm sure Robinhood ended up robbing me on the bid ask. Am I a pattern day trader on Robinhood? Yes, I believe so. Let me see how many day trades I've made in the past week. Settings. Nope, wrong one. Investing. Yeah, I have made 9 day trades in the past 3 days, so definitely flagged as a PDT. Switching my other account to cash account, that might not be a bad idea. The problem with the cash account is you can't trade spreads, and you have to wait for the money to clear. So it'll take the close of the trade plus the next day, the same day. So you won't be able to open a position until the next day with the same buying power that you're closing out of. So say that you close out of a trade for $500, that $500 won't be available for you to trade again until the next day after that trade. Yeah, Thinkorswim, they charge you the 65 cent fee in order to open each option, and the price for their options really aren't that much better than Robinhood. In my experience, they actually, from the Discord, all the people that I've been watching trade with me, they always get filled at the same price that I do. So I don't think that Thinkorswim is a better platform if you're looking for the best price. If you're looking for the best price on an option and you're willing to pay that 65 cent commission like you are for Thinkorswim, then E-Trade is going to be the best bet. How often do I negotiate for commissions? I don't. Since I use Robinhood, I don't pay commissions, but I do pay with the bid-ask spread, and can't really negotiate the bid-ask spread. I have a cash account, but you can use a debit card and load money if you really want to make another day trade the same day. Huh. I didn't know that. Interesting. Yeah, the bank transfers take forever, like 2-3 days. Especially if you have a cash account, then you don't have the instant deposit feature. Yes, E-Trade is definitely better than Thinkorswim when it comes to options pricing. In terms of the user interface, not so much, but E-Trade is definitely better whenever it comes to getting the best fills and getting the fastest fills from what I've seen in the Discord. If you don't want to pay a commission for your trades, what do I think of Webull? I mean, it's basically the same thing as Robinhood when it comes to the pricing for it. The problem with Webull that I don't like is that it's owned by Chinese company. So I would be worried if China and the US ever really got into it, that my broker account would be shut down because they decided to close the app or whatever. So for me, I wouldn't use it. But if you're looking for the best prices and you don't want to pay commission, Aries would be the best. If you sign up with that link that I just sent, you'll get $100 back after you deposit $500. You have to keep the $500 in there for 5 months, and you get paid $20 a month back. And then you'll also get tradearies.com, everything options. You also get 1 month of free premium access to my Discord. You'll have to go over to the bottom of the page, I think. Right here, scroll down, go to free premium, create a ticket. That ends up sending these right here. Looks like people are closing out of them. But you're supposed to upload some screenshots to it, confirming that you signed up for the account and confirming that you deposited the money. And then you'll get a free month of premium Discord, thanks to the Aries support team that I have on staff that's taking care of this. How come I don't use Aries? Because they barred me from trading for 90 days because my account balance went too low. I started a $3,000 account challenge. I ended up sending it from 3,000 to 9,000, and then I ended up going back to 3,000. After that, I ended up having to take out some cash in order to pay for an app that I'm developing right now. So I took out $2,000 of cash, so I only have 1,000 left in the account. So since I only have 1,000, I can't trade spreads. And they basically said that I can't trade until I make a deposit of like 2,000. So waiting to deposit some money into it, and then after that, I should start trading with Aries. Yeah. Well, it's saying that I'm PDT banned, but the customer service line was telling me that it was based on my account balance. Any tips not to get hit with the PDT rule if you need to manage your trades? That's kind of hard, I would say. I mean, with how volatile the markets are in the after hours these days, I would say that it's very difficult to avoid the PDT rule, especially if you're trading shorter expiration dates. You could always go longer in your expiration dates, though. Like if you're choosing, say, a 2-3 week expiration, then you would be less subject to the crazy volatility that you'll get from same day expirations, especially, and then from, 1-2 day expirations. So you could always go out further in your expiration, which that would be a better strategy if you want to avoid the PDT rule. PDT, pattern day trade rule. You can only make 3 day trades each week if your account is less than $25,000. Once you get above the $25,000 mark, then you can day trade as much as you would like. But the caveat is that if you have an interest-bearing account, like with Robinhood paying out 4%, then they're going to take that interest away. So there are drawbacks to it. But yeah. My crypto is stuck in KuCoin, owned by the East. Oof. Yeah, that's why I would avoid trading with Webull. I don't want to put my money into anything that could be, stopped by the Chinese government. But yeah, that's all the trades that I'll make today, and it's 11 o'clock, so I guess I will catch y'all tomorrow, Friday, at 9:30. See you, everybody. Is Ares U.S. owned? Yes, they are U.S. based. It's actually a third-party to TradeStation. It's just a different user interface. So they are U.S. owned. They are available in almost all countries except for Canada. There might be a few other countries that are missing, but for the most part, they're available worldwide, and they're U.S. based. Love you too, Ice Cold. See you tomorrow, man.